The third tenet of Dow theory asserts that market movements occur in three distinct trends: primary, secondary, and minor. The primary trend is the most significant, representing the long-term direction of the market, either bullish or bearish, and typically lasts from 1 year to several years. Dow believed that stock prices reflected all available information and the collective wisdom of investors, thus offering a reliable barometer of business conditions. After Dow's death, Dow theory remains relevant more than a century later. At its core, the Dow theory rests on 6 key principles that help us understand market behavior and trends. The market discounts everything. This tenet asserts that all available information, public and private, rational and emotional, is already reflected in stock prices, economic data, corporate earnings, political developments, and even investor sentiment are all absorbed into market movements. This principle serves as the cornerstone of modern technical analysis, emphasizing that price action itself provides the most comprehensive insight into market conditions. The third tenet of Dow theory asserts that market movements occur in 3 distinct trends: primary, secondary, and minor. The primary trend is the most significant, representing the long-term direction of the market, either bullish or bearish, and typically lasts from 1 year to several years. Within this overarching movement, secondary trends emerge as temporary reversals or corrections that move against the primary trend, often lasting weeks to a few months and retracing about 1/3 to 2/3 of the previous move. These are seen as natural pauses or adjustments within the broader trajectory. Finally, minor trends are short-term fluctuations that span days to weeks and reflect daily volatility or noise, often driven by news or investor sentiment. While minor trends are useful for short-term trading decisions, they are less reliable for understanding the market's overall direction. Recognizing these layered trends helps investors distinguish between temporary market movements and long-term shifts, allowing for more informed decisions and better timing of entries and exits. Averages must confirm each other. Dow proposed that the movements of the industrial and transportation averages must confirm one another to validate a trend. If the DJIA reaches new highs while the DJTA fails to do so, it signals inconsistency and potential weakness. The rationale is simple: industrial companies produce goods while transportation firms deliver them. A genuine economic expansion requires both sectors to thrive. Volume confirms the trend. Dow believed that trading volume should expand in the direction of the prevailing trend. In a bull market, volume should rise on rallies and decline during corrections. In a bear market, volume typically increases on declines and decreases during recoveries. Volume thus acts as a secondary indicator that validates the strength of price movements. Trends persist until clear reversal signals emerge. The final tenet asserts that trends continue until definitive evidence proves otherwise. Temporary corrections or fluctuations do not indicate a trend reversal unless they are accompanied by significant price and volume shifts. This concept aligns with Newton's first law of motion, applied metaphorically to markets. Momentum tends to persist unless acted upon by an opposing force. Dow theory represents far more than an analytical method. It is a philosophy of market behavior. It teaches that markets are driven by collective human emotion and that trends, once established, often reflect underlying economic realities. Even in a world dominated by artificial intelligence and quantitative models, the wisdom embedded in Dow theory continues to guide traders and investors who seek to interpret the language of markets.